First of all, I'm very surprised that many investors were skeptical about the trend for the price of gold. Our scenario of the three peaks. It's easy to remember. The three peaks, meaning relating to the peak in inflation, the peak in the US dollar, and the peak in interest rates. And back then, we said that all these three key data had started an inverted move. So basically, they stopped peaking and were heading south. And this is exactly what happened since the months of June or in the fall. And really, the market has really started reacting to those trends in the fall of 2022. To answer your question, we had a rebound in the price of gold, mainly because the data coming from the inflation front, the US dollar weakening, and the interest rates. Those three targets are plenty already to keep pushing the price of gold higher. Now, this being said, the questions that we can ask ourselves is how low are rates going to go? The questions we can ask ourselves is what is the pace of the disinflationary aggregates, and therefore how low also is the US dollar going to go? Price of gold will react again to those three key elements. We do believe that rates are going to continue going lower, and I will explain why. Do believe that the US currency is going to continue weakening. I can explain why. And we also believe that inflation is trending lower and will continue trending lower. There are two variables that really are strongly negatively correlated to the price of gold. It's real interest rates and it's the US currency. If I do have a clear vision on the direction of real rates and on the direction of the US currency, then I can make a call on the price of gold. Basically, as gold doesn't return any coupon, there are no coupon, no dividend related to the price of gold. So if rates go up, the arbitrage between gold that is not yielding any dividend and nominal rates is easy to make. The second point is, if the US dollar weakens, basically it means the US dollar is a counter-cyclical asset. Don't forget that. So when things go in the wrong direction, usually the safe haven asset is the US dollar. It's not gold. This is what your audience has to understand. So when there is a lot of stress in the markets, well, gold will be penalized and US currency will take over the price of gold. Let's look at what the economy and what the interest rates are telling us. Today, you have data coming from the American economy showing that not only the service component of the economy, but the manufacturing component of the economy are heading south. And not only are heading south, they just went beyond the 50 threshold, which basically tells you that we are in a contracting mode. So the economy is contracting, number one. That's why interest rates are going down. The labor market is weakening. We can discuss it as much as you want about it, but the labor market is weakening. And the wage, let's talk about wage, because a lot of people see inflation as being a consequence of higher wages, and they are right to look at it this way. But wages are also going down. Rents are going down, wages are going down, the service sectors are showing a contraction, and the manufacturing sector is showing a contraction. In this situation, rates are going down. That's why we think that rates are going to continue going down, and the US dollar. And remember, the only way, there are no other way to trigger a rebound in the economy is to use a weaker currency. And the United States know it very well, and they have played the US dollar very well all over the last few decades. So when the economy is going to weaken enough, then the US currency will weaken even further, and this is when you will have another lag for a higher price of gold. The expectations from the minutes of the FOMC, they are basically telling you that the Fed fund rates will head towards the 5.1%, which is extremely high. But at the same time, the market is telling you And this is key. At the same time, the market is telling you that those rates are not, the Fed fund rates are not going to hit the 5% threshold. Why? Because the 5-year, the 2-year nominal rates are way below that 5%. So the market is telling you that they don't believe that the Fed will be able to push its Fed fund rates to the 5% level. That's number one. And the reason why the market don't believe that the Fed funds is going to go to 5%, it's because we have an inverted yield curve. Now it's becoming a little bit more complex, but an inverted yield curve is telling you that is forecasting basically a recession. How could you continue increasing your rates when there are a lot of data that are showing you, demonstrating that the economy is weakening and heading towards a potential recession? So when you have a monetary policy that is restrictive, which is the case today, the monetary policy of the American government has been in a restrictive mode since the month of September. So to answer really the question, why did the market suddenly had appetite for gold?
Yes.
It's because the market understood in September, in the fall of 2022, that the restrictive monetary policy was going to affect the growth of the economy. And if the economy is starting to slow down, it means that rates cannot continue going up at the risk of creating an even bigger lag in a scenario. We do believe, as I said, that the PMI numbers, again, I repeat, these are important figures because the PMI for the services and the manufacturing sector, both of them now are sub 50. So basically, they are telling you that the economy is weakening big time, number one. Therefore, nominal rates will have to go down. However, inflation is still sticky. The core PCE, which is really the main figure that the Fed is looking at, it's still above 4.5%. Less, we do think that nominal rates will head further down and faster than the deflationary pressures. Hence, we believe that real rates will go lower faster. It's already incredible that we are talking about the target Fed fund rates of 5.1%. This is unheard of, unbelievable, when the break-even, the inflation break-even over 2 years, 5 years, 10 years are sitting around 2.2%. The market is telling you that 2 years down the road, inflation will be around 2.2%. So how can you continue restrictive monetary policy further down the road when the economy is going to slow down? Now, it's not obvious to a lot of participants, of course. Why? Because the last quarterly numbers coming from the US in terms of growth are staggering. The US economy generated is probably going to show a growth of 3.5%. So the market is saying, yes, we have reached peak rates. Yes, we have reached peak inflation. Yes, the US dollar is meant to go lower, but we still have an economy that is growing at 3.5%, which is enormous, outrageous, considering that we have all these data, leading indicators telling you that this is not going to be the case a quarter or 2 quarters down the road. The problem of the real estate sector in America is not related to buyers who are over indebted. It's related to the fact that you're not going to buy a house today when you sense that prices could go lower. So it's more an arbitrage that the consumers are doing today and betting on lower prices further down in 2023. So they are ready to purchase a new house, but the mortgage rates at 5.5% or slightly north of that is preventing them from being too aggressive, and they have the time. They can wait, and they decided to wait. The Fed is going to send signals. Really, we're talking about 1 or 2 quarters. We're not talking about 12 months down the road. When the Federal Reserve will understand, and they understand already, but they still have this political message to send that inflation is the first disease that they need to fight. So when the economy is going to slow dangerously and hit dangerous levels, the inflation, which is decelerating, will not become the main problem. The new main problem of the American government and of the Fed will be to make sure that we don't hit a recession, and that if we hit a recession, like in the first quarters of 2022, it will be very mild. And the only way to do that is to stop hiking rates and to start sending a message that is more dovish than it has been in the past year or so.